Good evening, ladies and gentlemen. My name is Christine, and thank you for joining us today at Corporate Connect this evening. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a pre-recorded presentation by Mr. Geoff Howie from SGX on recent market highlights, followed with a presentation by Mr. Chia, Chief Financial Officer, StarHub Ltd, and we will end off with a Q&A session. Without further ado, can we have the pre-recorded presentation on now, please, Zach?
Thank you very much, and good evening, everybody. My name is Geoff Howie. I'm Market Strategist at SGX, and very much like the charter of SIAS, tonight we'll be providing a quick educational overview of what's been driving Singapore stocks as of lately. So in the year to date so far, the Straits Times Index has actually generated a 9% gain, and that follows its 14% gain last year. Economic growth also rebounded last year by 7%. Now, what this means is over the past 5 years, the STI has now generated 7.5% annualized total returns, which has brought the 10-year average annualized total return to 4.7%, which is pretty much in the middle of the 3.4% average for Indonesia, Malaysia, and Thailand, and the 5.9% gain for Hong Kong on an average annualized basis. Now, global inflationary pressures early in 2022 have seen an earlier than previously expected withdrawal of accommodative monetary policies across the globe, while sequentially uneven global economic recoveries that span 2020 and 2021 fueled these divergent returns across the big stock sectors. The inflation concerns of early 2022 have also seen divergent sector returns across the world. Tied to the cause and the effect of inflation, energy and bank sectors have led global stocks, while technology stocks have underperformed to this point. Now, the world's biggest ingredient in the energy mix, it has continued and built on 2021 gains, with Brent crude oil futures forming a high of $96.48 a barrel last night, and WTI crude forming a high at $95.82 a barrel last night as well. And that price ratio spread of Brent crude to gold is now currently trading at a 32-month high. Secondly, container shipping market rates, as represented by the Freightos Baltic Global Index, have continued to consolidate near these highs. While it is down 15% from the September 2021 highs, this index remains more than 6 times its pre-pandemic norm. And on the back of the pandemic-induced factors that have included surging demand for goods, supply chain disruptions, and port congestion across the globe, the index has declined just only 0.3% last week. So the cause, high energy prices, supply chain bottlenecks, and the effect of the current wave of inflation has seen energy stocks lead the global stock market in 2022. And at the same time, global bank stocks have also led the global stock market on the interest rate normalization. So during January, the CME Fed Watch tool expectations for a US interest rate hike at the 16th of March FOMC, which is a little bit less than 6 weeks away. Those expectations for a rate hike increased from 50% to 100%. Moreover, since the FOMC on the 25th, 26th of January, expectations that the rate hike would be 50 basis points have risen from 3% to close to 60%. And this has seen the 2-10 US yield curve add to the 60 basis point upward structural shift of last year with a further 20 basis point upward shift. So US 10-year treasuries, they moved from 1.5% at the end of last year to 1.77% thereabouts at the end of January, and are currently just below 2%. So the imminent US interest rate increases are seen to positively impact net interest margins of the banks, which along with the size of their customer loan books very much drives net interest income. So we saw a DBS report yesterday, and from the last quarter of 2019 through to the last quarter of 2021, DBS's net interest margin declined by more than 40 basis points from 1.86% in the fourth quarter of 2019 to 1.43% in the fourth quarter of 2021. That was amid the extraordinarily low interest rates across the world, while at the same time, the higher proportion of current and savings accounts as a proportion of customer deposits has grown to 76% at the end of 2021 from 59% at the end of 2019. So these net interest income potentially having a much better outlook with normalized interest rates has been a key driver, not just for the local banks, but global banks across the world. And for tailwinds, really, DBS, OCBC, and UOB, they generated 17% average returns since the end of 2021, and that's with a combined net institutional inflow of 1.4 billion Sing dollars. That followed 1.7 billion Sing dollars of net institutional inflow in 2021 and 2.3 billion Singapore dollars of net institutional outflow in 2020. So together, the STI is represented by these three banks by as much as 45% of the STI weights. So that has been a key driver of the performance of the STI since the end of last year, which has seen the STI lead all the Asia Pacific benchmarks and being second to the Brazil benchmark in terms of the performances of global benchmarks across the world since the end of last year. So looking across the sectors, energy has continued to lead in the early 2020 months after also leading last year. Geo Energy Resources, Rex International, and RH Petrogas are among a select group of stocks that are involved in the exploration and the production of energy resources, and they've averaged 26% gains so far this year. Meanwhile, Sembcorp Industries, which has pressed on with its strategic transformation from its portfolio of brown to green energy, generated a 23% return, keeping pace with those stocks. Sembcorp Industries, Geo Energy Resources, and Rex ranked among the 20 Singapore-listed stocks with the highest net institutional buying in January, while RH Petrogas ranked just outside the top 30. And meanwhile, as I think we mentioned in the January presentation, Rex International has also announced plans to transfer its listing from Catalyst to the mainboard. Now, while energy and bank stocks saw more tailwinds, globally, REITs and technology stocks have been among the least performing sectors since the end of last year. 7 of our REITs represent 15% of the STI weights. Now, the repriced outlook for higher borrowing costs has weighed REITs globally, but what we're seeing in Singapore is office rents in the central region are also currently expected to improve further this year on the back of the improving economy and tight supply, and retail sales also saw a notch up in momentum at the end of 2021, and that's brought retail sales growth in Singapore to 11% for the whole year last year. And in line with this, when reporting their FY21 results, the CapitaLand Integrated Commercial Trust CEO noted that CapitaLand Integrated Commercial Trust portfolio valuation at the end of 2021 was up 3.5% year on year, which signified an improving outlook for Singapore's retail and office market. Now, the spike in energy costs, on the other hand, with the recent supply chain bottlenecks, have given global investors a reason to adjust some of their exposure in technology stocks, taking some of the money off the table after the strong returns of tech stocks in 2021, and which was on the back of the demand of semiconductor, 5G, cloud, and data center services. AEM and Franken both generated total returns of just over 50% last year and have averaged 15% decline so far this year. UMS and ISDN both generated 80% returns last year. UMS has declined close to 20% this year, while ISDN has declined 8%. Grand Venture Technology also declined 13% so far this year after rallying 260% last year and moving from the Catalyst board to the main board. Like the local tech stocks, the Philadelphia SOX index, semiconductor index, has also given back around a quarter of its 2021 gains in the year to date. But ongoing digitalization, it's not just had an impact on tech stocks, And it's also had an impact on the bank stocks, obviously. It's also had a big impact on telecommunication stocks. In the 2022 year to date, Singtel has seen the next highest amount of net institutional buying after the three banks, with the stock generating a 10% return. And this morning, the company provided a business update for its third quarter, ending 31st December, which also included an update on its ongoing strategic reset to develop new growth engines in information and communications technology. And of course, its digital services ICT arm, which is NCS. That reported a changed revenue mix, which significantly, I guess, changed over the 9 months, ending the 31st December, because it's been able to grow its digital revenue in NCS by 27% year on year, and that contributed to very close to 50% of NCS's total revenue. So the telecommunications sector, it has changed significantly in Singapore, as we know, over the past few years. The introduction of new mobile virtual network services, providing the provision of broadband services as well, reducing the cost of mobile data, phone plans for users, and so forth, have been key drivers. And over the past 2 years, digital technology and platforms have even become more critical to daily life. So if you also take a lens from outside the stock market, digitalization is also expected to remain an overarching economic theme this year, with the ASEAN Comprehensive Recovery Framework maintaining, 4 months ago in October, that the acceleration of inclusive digital transformation is one of the 5 broad strategies to take the region through the recovery process and to build this long-term economic resilience. At StarHub's 2021 Investor Day, I think it was back on the 22nd of November last year, it launched its next 5-year strategic transformation and growth program, DARE+, which follows the DARE 1.0 program, which ended in October 2021 and delivered cost savings of over 270 million, which exceeded the original target, which I think was 210 million. So DARE+ sees StarHub intending to leverage off the continued introduction of new 5G projects and solutions, and further operate cost savings through digitalization, and also pursue its progressive declines in fixed costs. So I should end on that. I'll just bring up a couple more slides because I'm like our watchers and listeners tonight, very much looking forward to this next presentation. But before we do, just a quick update on what we've seen in the recent week. Themes such as the gradual reopening outlook, the aforementioned global inflation that we discussed a few slides ago, and the ongoing strategic initiatives to obviously restructure businesses, in addition to valuations, are possible factors that have had an impact on the 30 stocks that have drawn the most net institutional inflows in the first 7 sessions of February. So among these 30 stocks that are tabled here, those that have attracted net institutional buying in early February, after drawing net institutional selling in January, include ComfortDelGro Corporation, in addition to the 2 manufacturers that are part of the SDI, Singapore Tech Engineering and Venture Corporations. But looking back a little longer, so of these 30 stocks, as many as 15 of them have attracted net institutional inflows over the first 7 weeks of the year, that is since the end of 2021. And that is after they attracted net institutional outflows in 2021. So stocks that have seen outflows last year, but inflows so far this year for institutions, and that's on a net basis, they include stocks such as Keppel Corporation, CapitaLand Integrated Commercial Trust. What else is there? There's Singapore Airlines, Gunting Singapore, Riverstone Holdings, Singapore Telecommunications, Singapore Exchange, Suntec REIT, Wilmar International, Sheng Xiong Group, Hong Kong Land Holdings, City Developments, Keppel REIT, Zhejiang Chemical Group, and Mapletree North Asia Commercial Trust. So those 15 stocks have attracted net institutional inflows so far this year, after being recipient of net institutional outflows last year. And the majority of those 15 stocks are also presently trading at a lower price to book ratio than their respective ratio pre-COVID at the end of 2019. Meanwhile, the majority of the 30 stocks that have attracted net institutional inflows so far this year and net institutional inflows last year are presently trading at higher price to book ratios than they were at the end of 2019. So in conclusion, and looking, I guess, across the world, the IMF back in January, what did it do? If it gave a reason for downwardly revising its global growth forecast from 4.9% to 4.4%. That's still above trend, but it was largely due to the pandemic's continued grip, the continued supply chain disruptions in the last quarter of 2021, hindering global manufacturing somewhat, and then the aforementioned broadening price pressures is seeing that earlier than expected withdrawal of monetary accommodation. There's been sectors that have received headwinds and tailwinds on the back of that. But the objective of this presentation was really just to quickly discuss how those factors are playing into the stock market here in Singapore. Markets of late have been moving quickly. For instance, since that smoothed average of new daily confirmed cases moved below 3 million cases back on 3rd of February, globally, airline, hospitality, and leisure stocks have led the global stock market. So plenty going on, plenty to stay attuned to. As you know, we have plenty of reports and educational material to help support you. And if you have any more questions whatsoever, please don't hesitate to reach out and contact us. And I'll finish here. Thank you so much.
Up next, we are pleased to have Mr. Chia, Chief Financial Officer of StarHub Ltd, to share with us more about the company. Chia, please.
Hi, good evening, and good evening, everyone, and happy Chinese New Year. This is the last day of the 15 days, so hope everyone has had a good Chinese New Year so far, and wishing everyone a healthy and prosperous year ahead. I'll just move on and cover some of the slides very quickly. On slide number 3, I just want to highlight that obviously the StarHub has now, and we will be celebrating our 22nd birthday on April the 1st, come 2022, April the 1st. We obviously, as a telco, have grown up as traditionally a consumer company, and we're best known for our consumer services such as our mobile wireless services, TV as well as broadband. But of the recent 8-9 years, we've actually grown our enterprise business quite significantly and built significant capabilities in the areas of cybersecurity, managed cloud, managed analytics, and we also provide a whole slew of infocom technology, what we call ICT services. And this is through a bunch of our recent acquisitions that we've done in the last few years as well. We are obviously the number 2 telco in Singapore. We've got over 1 in 2 households, proud StarHub customers of ours. We've got over 2 million mobile subscribers and over 400,000 each of entertainment and broadband subscribers. The next slide. This, as highlighted, were some of our recent acquisitions, joint ventures. Unsigned being the cybersecurity pure play in Singapore, and we are the proud shareholder of 60% of Unsigned, along with our joint venture partner, Temasek, which we formed in 2018. JOS, which we recently acquired on 3rd January of 2022, the transaction was completed, and we will be consolidating the full year results of JOS coming through in 2022. Strategist, which is the ICT player in Malaysia, a leading ICT player in Malaysia, which we completed in July of 2020 amidst the COVID situation. And MyRepublic, which we had announced late last year, we expect to complete this transaction sometime in Q1 of this year. All of these acquisitions have a strategy behind them. We look to harness synergies through cross-selling and upselling opportunities, through the various capabilities and skill sets, as well as products and services that we've developed across the StarHub Group. This is our shareholding structure, and obviously our main shareholder is Asia Mobile Holdings, which is a joint venture between Ooredoo, which is a Qatar telco, as well as ST Telemedia, which is in turn 100% owned by Temasek. Our public float currently sits at about 34%. We recently announced our financial results last Friday on February the 11th evening, and the results that we unveiled for the full year, bearing in mind that our financial year end is December, we recorded an increase in total revenue coming through with primarily from our growth in various enterprise solutions business around ICT. These were somewhat offset by a couple of headwinds in other lines of business. I'll walk through the segmental revenue in the next slide. EBITDA margins for the full year closed in about in the high 29%, about 30%. This was consistent across the 4 quarters last year in 2021. And this was a significant improvement compared to 2020, where if we back off the job support scheme numbers in terms of comparatives. Service revenue wise, 1.4% increase year on year, and this is also representative of our various the movements in our various lines of business. Net profit for the full year was an increase of 17%. For the second half of 2021 was an increase of about 27%. In terms of segmental revenue on the next slide, just speaking quickly through mobile. Mobile is a combination of both postpaid as well as prepaid. And bearing in mind that mobile revenues for 2021 did not include a lot of roaming. In fact, it was hardly any roaming coming through. Bearing in mind that 2021 was a year where the borders, international borders were largely closed for almost the entire year, with perhaps a slight reopening coming through with the VTL flights in sometime in December. Aside from that, largely the borders were closed for the entire year. So you didn't have any mobile revenues coming, roaming revenues coming through in postpaid in 2021. There were a few months of roaming revenues that we managed to record in 2020, bearing in mind that the borders started closing sometime in Q2 of 2020. So in essence, the roaming revenue impacts came through in 2021, which hit the postpaid segment as well as the prepaid segment. A prepaid segment being contributed by the foreign tourist footfalls that come into Singapore. Other than that, obviously, in terms of the mobile outputs, we continue to grow that reasonably well in terms of the services that we provided, and we are actually very proud to share that our 5G subscribers now exceed over 300,000. So we're making good traction in terms of various services that we launch on the mobile side. And as the world reopens, we do expect some recovery in the roaming revenues. In terms of the broadband segment, that continues to see very nice growth, about 10% increase year on year in terms of the service revenues coming from broadband. And this is largely from uplifts and outputs, as well as the sunsetting of various promotional plans that we used to offer to our subscribers. That said, obviously our broadband plans still remain very competitive, and we pride ourselves in providing a high level of customer excellence in providing our broadband connectivity as well. Entertainment-wise, we've now renamed this segment. In the past, we used to call this pay TV. Of course, as pay TV and the viewing options have now morphed into a lot of OTT, or what we call over-the-top streaming options. This entertainment segment now encompasses the services we provide on the OTT side, as well as other services such as cloud gaming that we recently launched late last year, as well as other services that we endeavor to provide in terms of the breadth of value that we bring to our customers. Our entertainment revenues had a slight decline, and this represents a structural decline primarily from the migration of our pay TV subscribers out of the traditional pay TV options into OTT options. Finally, in terms of enterprise, and enterprise represents an amalgamation of our network solutions business, as well as cybersecurity business and ICT, regional ICT entities coming in the form of Strateg and JOS, which we acquired this year, which will be included in the regional ICT bucket. Cybersecurity registered a very nice growth year on year, about 20%. And Strateg in Malaysia, despite challenging conditions brought about by COVID in 2021, also registered a growth year on year. Network solutions wise, in terms of traditional connectivity revenues and ARPU, or what we call ARPAs, average revenue per account rather than average revenue per user, that continue to face some structural challenges in terms of the pricing erosions. In terms of the managed ICT services provided in Singapore, we actually recorded a modest growth as well. Going into the financials, I'll just highlight really here, the key highlight was our free cash flow that we generated in 2021 of $485 million or 27.9 cents per share. Our EPS for last year was about 8.1 cents per share and 1.04 times in terms of leverage. This positions us very well in terms of balance sheet capacity to fund our future growth plans. Next slide. Key highlight here is really the free cash flow improvements that we mentioned, and the fact that obviously we saw quite a fair bit of improvements in our various working capital lines, improvements in our collection days from our customers, as well as better terms that we secured with our vendors. As a result, the higher EPS anticipated that we generated in 2021, we have declared a full year dividend of 6.4 cents. Bear in mind that 2.5 cents was the dividend we declared in the interim when we announced our half year results in August. Our final dividend that we endeavor to pay out is 3.9 cents, which is in line with our policy to pay at least 80% of the net profit after tax that we generate in any given year. So in terms of the guidance, we had guided to a stable service revenue. We reported a growth in revenue of 1.4%. We had guided to about at least 26% in terms of service EBITDA margin. Our full year EBITDA margin that we reported was 29.8%, well ahead of the guidance. We had reported or guided CapEx or capital expenditure to be between 7 to 9%. Due to some timing matters in terms of commitments of some of the capital expenditure, primarily around our IT transformation initiatives, as well as some 5G expenditure, our CapEx came in at about slightly below 4%. And we had guaranteed or assured the market that we'll pay at least 5 cents. The higher 5 cents or 80% of net profit after tax, and that number translated into 6.4 cents for the full year. So for FY21, believe StarHub had a good year all around. Our financial results were strong, positions ourselves very well in terms of balance sheet capacity. We have $832 million of cash at the end of 2021 in our balance sheet, and we were then therefore able to pay a higher dividend than previously guided based on the net profit that we generated. Just moving quickly, in terms of the DARE+, which we unveiled in Investor Day in late 2021, we had guided the market that we will be undertaking the next chapter of our DARE initiatives. Having completed the DARE 1.0 in October of 2021, the 3-year journey saw us generating over $270 million of outcomes. We had guided the market into 2018 when we first embarked on this journey that we would aim to endeavor to achieve 210 million. We recorded a number which is well above that of over 270 million. Our next chapter of DARE+ involves primarily growing the top line in terms of revenue growth, as well as cost transformation initiatives coming through as a result of the digital transformation of our business model. Obviously, this entails upfront investments in terms of our replacement of various IT platforms, as well as our ongoing investments in our 5G infrastructure to enable us to compete effectively and provide value-added solutions and services to our customers. The 3-year investment that we envisage is about $270 million. coming through in both capital as well as operating expenditure. We endeavor to generate about over $500 million of outcomes, coming through with $220 million of margins that we intend to generate from revenue growth, as well as $280 million of cost transformation outcomes coming from digital transformation of a business model, reduction of footprint, reduction in transaction processing time, as well as the consolidation of various IT systems and the reduction of repair and maintenance expenses in relation to that. On the steady state, what we've also guided the market in November of last year during our Investor Day is that we aim to generate about at least $80 million of after-tax margins as a steady state from 2026 onwards. So these are upfront investments which will present near-term pressures to our margins, which then goes into why we have guided to a lower margin for 2022, but we expect to generate the outcomes from 2023 onwards. Next slide. 2020 margins, we have guided the market that it will be at least 20% on the back of an increase in service revenue of at least 10%, coming through from ongoing growth in our cybersecurity business, consolidation of jobs which was completed in January this year, and the MyRepublic acquisition, which we expect to complete in Q1 shortly in the next few weeks. Our margin pressures for 2022 come primarily from upfront investments in IT infrastructure, as well as our 5G network, the ongoing rollout of our 5G infrastructure, as well as some inflationary costs coming through from increased utility costs as a result of the significantly higher crude oil prices that we're seeing today. 2023, we expect to continue with this revenue growth. So for the first time, you're seeing in many years, we have started to report and we're starting to generate growth in our top line, which we believe would be accretive to shareholders over a period of time. So we endeavor, and the outlook is for a 5 to 10% increase in service revenues in 2023, and improvement in service EBITDA margins at that point in time, coming through from the DARE+ outcomes, which will start coming through in the second half of 2023 and onwards into the future years. In these numbers, we have not built in a significant recovery in roaming revenues. So anything coming through from the reopening of the world's borders and a resumption of travel will be upsides to these numbers. For a lot of these acquisitions that we've done, we've not assumed a lot synergies that come through in the form of collaborative and cross-selling and upselling opportunities, as well as some level of cost optimizations. All of these initiatives in terms of synergies have not been built into these numbers. For capital expenditure, we obviously on a steady state, we believe we'll be able to maintain it between 7 to 9%. For 2022 and 2023, there will be an uplift of 3 to 4% coming through from additional capex for IT stacks and IT systems that we would be looking to implement. For 2022 and 2023, we expect to continue paying the higher of 5 cents or 80% of our net profit after tax. So we are assuring investors and shareholders that we will be able to at least pay 5 cents for this year, 2022, as well as 2023. Next page. So I just want to round off in terms of the priorities at StarHub and where we're focusing our energy in terms of managing the company for the long-term viability. We have been branded and we've always prided ourselves with being a quad play, being able to provide a host of different services. We endeavor going forward to be an infinity play, meaning that we will bolt on a number of additional services on top of our base services, such as insurance and other related services such as cloud gaming that we've already launched, and a few other services that we intend and endeavor to launch. Through this, we aim to provide an end-to-end solution and a one-stop provider in many respects to our customers, both consumers and enterprises alike. The super app and digital engagement, of course, we aim to be an agile and cloud player, recognizing technology and the evolution of where we are moving towards. This is something from a platform perspective, we aim to be able to provide the slew of services and the ease of doing business and transacting with StarHub through the platforms. Enterprise, in terms of the capabilities that we have already invested in over the last few years and will continue to invest in, all of these will start converging together alongside with our connectivity provision in terms of the services we are able to provide. And through cloud cybersecurity, we provide the most secure connectivity in the market. That's what we aim to do. 5G enabled opportunities, now having started our journey in terms of our rollout. And now that we've bolted on the 2100 spectrum, which was awarded as part of a spectrum option in 2021, late 2021, we continue to roll out a quality network that will meet the connectivity requirements of our subscribers in Singapore. Something that I pride myself that we've done very well over the last few years and continue to do is disciplined expenditure, something we will continue to optimize in terms of investing for the future, but looking at how we will optimize the short term in terms of both operating and capital expenditure. And finally, in terms of additional acquisitions and strategic acquisitions, having now demonstrated our successful acquisitions in the last 3 or 4 years, we continue to look for opportunities in the market to add on to our DARE+ execution. So that's a quick summary of our results for 2021, our priorities for the future, our guidance for 2021, 2022 and 2023 in terms of our outlook. And I'm happy to take any questions that anyone has at this point. Thank you for your time.
Thank you very much, Dennis, for the great presentation. Quite a few questions from the floor, talking about transformation expenses, forecast earnings, and of course, one of our favorites is share price. So maybe let's start with something dear to the heart of StarHub, transformation DARE+. So there's a question from the floor from Mr. Ong Jing Jie, talking about transformation costs. Would that be recognized in 2022? And would that offset the cost savings of 35 million and projected increase in revenue of 10%?
Yes. So it actually will, whatever we are, in that slide, we've shown that we are looking to incur about $270 million of investments in transformation initiatives. A lot of the 270 million is going to be recorded in 2022, which is this current financial year. And of course, will then offset the savings that we envisage to generate of 35 million. So the transformation expenses or expenditure that we'll be recording in 2022 will exceed the $35 million that we'll generate this year. But we will endeavor to generate the outcomes coming into the future years. And of course, if you look at that slide where we had the 5-year projection of $500 million of outcomes, which will well offset the 270 that we have to invest in the 3 years. So of course, like any investment, it would be great if we can time the outcomes along with when we have to spend and pay for it. A reality in business, a lot of these will entail an upfront cost, and then you generate the outcome subsequently. So there will be near-term pressures coming through for 2022 and for a good part of 2023 as well.
Thanks, Dennis, for that. There's a following question about forecast earnings, upfront resources. How do you convince shareholders of the revenue stream over the next couple of years?
I will answer the question in a number of parts. One was the DARE 1.0 that we guided the market in October of 2018. Having completed a journey in October 21, we have now shared with the market that the outcomes well exceeded 210. In fact, we generated about $273 million of outcomes coming through that. In all of the last few years, when we've guided the market in terms of both margins as well as growth, in top lines as well as dividends. We've always met or exceeded the targets. Of course, whatever we endeavor to invest to generate the DARE Plus and to fund our DARE Plus growth, it has some level of risk behind it. However, having now demonstrated how we manage as the manage the company in terms of making decisions, both from a balanced risk perspective as well as to manage the company for long-term viability. It is that which we hope investors will have the confidence in us, having thought through this very carefully in terms of why we need to make these investments and why we need to transform our business model to stay viable. So that's the only assurance I can give you from that standpoint. And also the other point, having done the various M&As in the last few years, each of them have all been very successful in terms of generating the growth that we had hoped to generate from there, as well as the margin uplifts that came through. So each of them have delivered in that sense. So we of course hope to continue and will certainly aim to continue that track record.
Thanks, Dennis. There's a follow-on question from Mr. Ong about the transformation expenses. How much of that will be capitalized and how much of it will be expensed off? Okay.
A good part, about 65% of that will be expensed because the reality of the current accounting standards is that they are very prescriptive. So by the nature of whatever you incur and what we need to incur in terms of IT licenses and so forth, a lot of them are actually treated as operating expenses in nature and cannot be capitalized. So about 65% of that will need to be expensed over the next couple of years. And then the rest of the 35% will actually be capitalized and then amortized subsequently. So because of that, there will be a mismatch in terms of when we record the investments and the expenditure versus when we actually get and generate the outcomes and then record that into our P&L.
Okay, thanks, Dennis. Question on investments, MyRepublic. I know you mentioned not earlier is that's occurring. Do you know the status of that right now?
Yeah, the MyRepublic transaction, like any market consolidation acquisition, involves an approval or procuring an approval from the regulators. So we believe that's on the way, and that's something that we continue to engage with the regulators on. While we will not be able to definitively ensure the date that we will get the approval, we do believe that it will be sometime in Q1.
Thanks, Dennis. A broader question now, Dennis, in terms of where the money is. If you were a betting man, where are the margins? Where are the growth areas?
Okay. I will probably answer the question that I'm probably the worst person to ask from as a betting man, because my personal investments never do well because I end up betting on the wrong things sometimes. But I will say that in terms of the telco industry, the very interesting thing is the last few years you've seen a massive erosion in the telco industry. Back in the days, about 6 or 7 years ago, broadband prices that we were able to charge in the market were probably about 65, in the high 60s. Today, they're like in the low 30s, so it's like half that price. Fast forward the clock, about 5 or 6 years later, you look at the mobile market, and while we were able to charge an effectively, $40 or $42 on an average, for each mobile plan. Today, they're in the high 20s, so that's a good 30-40% erosion in there. And then you look at the pay TV segment. Over time, there's been a structural migration out of pay TV into OTT, and OTT typically attract lower outputs, right? So I suppose that is a long way of answering this question to say, is it the bottom? Is it near the bottom, or is it the bottom? My personal view, honestly, is that this erosion has gone on very long. As like any industry, there's always a plateau and a trough, and eventually recovers. I do believe there'll be some rationality in the market going forward, bearing in mind that we are all investing in rolling out 5G networks. So there's no way that we can invest in rolling hundreds of millions in rolling out a 5G network and not be able to generate some level of returns coming through from that as well. So obviously from a pricing standpoint, there'll be some rationality coming through from that. And of course, as you see over time, less and less players in the market. The best example of that was in the electricity side. So we look at last year, a whole bunch of electricity retail providers have exited the market. Seeing how difficult it would be to compete. I would imagine that at some point in time, sooner than later, in the mobile market and the telco market, it will be the same phenomenon again. I mean, in any competitive economic situation, you can't have too many players. So when you come to a situation where the number of players are somewhat more compressed, the pricing situation will become more rational at that point as well. So that would be my view of how things should play out over a period of time. But as we all know, sometimes there are other forces that we don't control. So that's my personal view on this.
Thanks, Dennis. A more topical question on cybersecurity, phishing, scams, SMS. Do you think this opens up opportunities for StarHub in terms of your security portfolio?
The cybersecurity situation is an excellent opportunity. The reason behind this is twofold, right? One is governments around the world, and starting with Singapore, have made it a lot more onerous in terms of cybersecurity requirements. The recent scams around the banking sector and so forth, and the debates in Parliament, yesterday, over what and who should be responsible for managing these scams is actually interesting. But the short outcome is that everybody would be expected to secure and provide more secure services over a period of time. That presents a unique opportunity for us, having now grown the Unsigned practice into a very credible practice and secured very huge contracts, not just in Singapore and around the region. So this is a good opportunity for us to capitalize on it and to see how we can also export these capabilities into the region, not just Singapore. Because the reality is that governments around the region as well as around the world require and expect the secured services to be the mainstay of how people operate or how corporates. So the short answer is a unique and very good opportunity for us.
Any specific accounts that is not confidential and you can name that you've won from the Unsigned platform?
Well, I think a lot of them are confidential. In fact, if not all, I will not be able to name specifics, but I can tell you that many of the major government bodies and the ministries have awarded contracts to Unsigned. And actually more importantly, a number of commercial operations in Singapore as well as in the region. So these are non-government entities like corporates and MNCs have also awarded contracts to Unsigned in Singapore as well as in the region. So we've got a nice mix of both government and commercial contracts. In some cases, the contracts runs into like a couple $100 million over a number of years. So it's actually very healthy contract values over a period of time as well, and recurring revenues.
Thanks, Dennis. We got about 10 more minutes to go. A couple more questions. Let's go to Mr. Michael Young. He says a question on asset recycling, optimization opportunities. Anything that on the block on that front?
Look, the asset. What we've done with the 5G infrastructure sharing with another operator was our version of optimizing the asset infrastructure and expenditure. Having now embarked on this journey on 5G, it will probably make a lot of sense to continue with this journey and the optimization through sharing of the infrastructure. Bearing in mind, of course, Singapore is a small market in relative terms. So it makes complete sense to combine resources and not build out infrastructure all at the same time. So we continue to be in dialogue with our partners to look at how to optimize this, and I do expect that we'll be continuing with this journey over a period of time. In terms of the existing assets, primarily in the form of the 4G infrastructure and other fiber assets, having now already incurred these expenditures and already done the rollout, it actually is a lot more challenging to try and combine the assets based on whatever already existed in terms of existing infrastructure. So while we will never say no to an optimization opportunity in this space, it is more relevant in terms of future rollouts and future expenditure, which is something that we're doing.
Thanks, Dennis. Quite a few questions on share price. You want to comment on that?
Okay. If you take and this is along the grains of the betting man question that came about, right? Look, I mean, it's definitely attached to a few things. The very first and very important thing is whether or not, as an investor, you see a potential recovery in the near term in terms of pricing in the market, right? And whether or not there'll be a rationalization in terms of number of competitors in the market based on pure economic factors. If you hold my view that at some point sooner than later there should be through economic forces of demand and supply a reduction in terms of number of players, because it's a case of survival and viability of businesses, right? And when you don't have enough scale, there's no room for you to continue operating. Then you would then believe that there should be some recovery over a period of time sooner than later in terms of pricing levels that exist in the market. Any increase in pricing levels and potential increase in pricing levels go straight to our bottom line, right? That bearing in mind that it's all based on sunk costs. Secondly, the expectations of roaming recovery and whether borders will reopen. I think everyone is now talking about reopening the borders, now treating the current situation as an endemic and removing restrictions because it's been 2 years and economies need to start opening again. So again, you need to take a view of what that will be and how quickly that will return. Thirdly, and very importantly, in fact, the most important is your confidence in management's execution. We have delivered in the past. We are making a fairly big bet in terms of our upfront investments over 3 years, over $200 million. It's not a small sum. It's not a small investment. We have made a number of bets in terms of M&A acquisitions, and we have now incurred over 200 and about $300 million M&A acquisition costs. You then need to take a view of whether management is able to execute and extract the financial value out of these investments and the outcomes that we guided the market on. If you believe us and you actually believe that we will be able to generate the $80 million of steady state net profit, starting from year 4, year 5, then and you just multiply the $80 million against our price earnings ratio or whatever we're trading at, which is about 15, then that's the additional value to the market cap that you can expect. But it's all predicated, of course, on expectations of our execution capabilities and on the fact that all market forces remain as what you see today. As we know, we unfortunately don't operate in a vacuum. There are a lot of things happening. I mean, what we've seen in the oil prices in the recent months is earth-shattering, to be honest. It's shocking to see where things have gone, and there are many external factors that we can't control, and we wouldn't use that as excuses for not delivering on what we can do. But whatever we can control, management works very hard to generate the outcomes of shareholders. So it's a combination of your assessments of market forces as well as management's capabilities. And if you take a view that both are on the positive trend, then obviously, there should be a nice uplift to the share price over a period of time.
That's good to hear, Dennis. A couple more questions before we end the session of Corporate Connect for this evening, and we'd like to thank staff for your time. There's a question on revenue mix, and there's a question on 4G versus 5G in terms of expenses to net link. Maybe you talk about 4G versus 5G expenses, Dennis.
Sure. So the 4G, today we have effectively now 3 networks, right? The 3G network, which is still not sunset, the 4G network, which is in flight, and then the 5G. Now, there are still a bunch of mobile phones that are only 3G enabled. And so bearing that in mind, before we even shut down 3G at some point in time, we will need to ensure our customers are able to move to at least a 4G phone before the 3G services are shut. But like the way 2G was shut some years ago, 3G will sunset at some point in time in the near future. The 4G expenses continue because it's still a viable network, and most of our subscribers are still on the 4G. The 5G network, of course, will take some time to roll out and to achieve the right coverage level in order for customers to viably migrate to that network. But any 4G expenses that we incur today, there's no more additional capex, no more meaningful capex that we're rolling, because obviously we're redirecting it to the 5G capex instead, being the new asset and the new technology. And any repair and maintenance, what we call R&M, on the 4G is actually minimized, because we're just keeping the infrastructure as it is, ensuring that the quality of service to our subscribers is still there. But we are obviously redirecting our focus on 5G, which is the new generation of the technology. So most of the expenditure, in terms of the relative expenditure, will go into 5G going forward as opposed to 4G.
Thanks, Dennis. One more final question before we come to the end. Mr. Ong asked about the revenue mix between enterprise and consumer. What's the optimal mix that you have foreseen for StarHub?
I would not say it's an optimal mix, but rather I will say that we envisage that eventually the revenue mix between consumer and enterprise will literally be 50-50. Because it's the way we are seeing the business morph, and the trends that we're seeing in the industry. As recently as 10 years ago, consumer accounted for 75% of our numbers, right? So we were barely generating about 20-25% from enterprise. So how things have changed over time, and of course in terms of enterprise capabilities and solutions, is something that can also be exported in terms of capabilities. So case in point, like cybersecurity, it doesn't depend on an infrastructure. It doesn't depend on a network infrastructure. So these are things that we've invested in because they can be virtualized, and they can actually be taken overseas, and you don't need to depend on a mobile infrastructure. So for us to provide telco connectivity services in Malaysia, we do need a telco network, which we don't. So there's no way we can generate consumer revenues in Malaysia from mobile because we don't have the infrastructure. But we can well generate enterprise revenues in Malaysia, for example, because there are capabilities that we can export from Singapore into Malaysia, and those are things that we've invested significant and meaningful dollars in building. So over time, because of the world we operate in, it will go into a 50-50 mode, and a lot of the 50% coming from enterprise will come from overseas as well. So there'll be a nice diversification of revenue streams over a period of time.
Excellent responses, Dennis. And with that, maybe one last word from you, Dennis. Just one word, how would you describe StarHub to our investors on this program this evening?
One word. Well, I would say it's now 6.5 years of my journey with StarHub. The key word I always say to people: challenging. This has been the most challenging job and career that I've had, and it continues to be a very exciting industry to be in. So both challenging and exciting. I know you asked for one word, but I would say it continues to be a very exciting journey for myself personally, and And I'm very excited for StarHub as a company going forward, because I do see a good optimistic road ahead of us.
Thank you, Dennis. Well spoken. And thank you, staff, for your time this evening.
Thank
And
you
with
for
that-
having us.
Thank you. And with that, the investors and audience, thank you for your time this evening. I'll hand it over back to the administration to close out this evening.
Thank you, Mr. Loh and Mr. Chia, for joining us on the panel today. We have come to the end of the session. Thank you everyone for joining us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. Do like our channel and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a good evening.
Thank you.
Thank you.
Thank you.
Bye-bye.
Bye.